The couch potato portfolio was created by investing writer Scott Burns. Here we'll take a look at its components, historical performance, and the best ETFs to use in its implementation. Scott Burns, creator of the couch potato portfolio, is a finance columnist and co-founder of assetbuilder.com. You can read more about him at scottburns.com. What is the couch potato portfolio? Scott Burns created the couch potato portfolio in 1991. In terms of lazy portfolios, the couch potato portfolio is about as simple as it gets, a 50-50 mix of stocks and bonds, using only two funds. Burns maintains that this makes it probably the most accessible and easy to understand portfolio out there, stating that anyone who can divide by two can understand it. The basic premise for the 50-50 allocation is, again, simplicity and the idea that stocks can drive returns while bonds help protect against stock crashes and lower the portfolio's volatility. The portfolio is essentially a slightly more conservative version of a traditional 60-40 portfolio. Interestingly, adherence to Burns's precise prescription of funds for the couch potato portfolio doesn't seem to be required and varies among investors. That is, you could use an S&P 500 index fund, a total US stock market fund, or a total world stock market fund on the equity side. On the bond side, you could use intermediate treasuries, total bond market funds, etc. In fact, Burns tells of how immediately after he initially published the portfolio, readers called in to ask him exactly how to implement it. Burns himself has actually used several different recommendations of specific assets over the years, all while keeping it pretty general and still allowing you to DIY it. In describing the original iteration of the couch potato portfolio in his article, Burns suggests an S&P 500 index fund and a short-term government bond fund. Fast forward to 2018 and he mentions total stock market funds and total bond market funds. Burns submits that more important than the fund choices are the fundamental requirements of low-fee indexing, diversification, and simplicity, and states that the single most important thing is the basic 50-50 mix of stocks and bonds. This is consistent with Burns's writings on investing. He aims to be an antidote to Wall Street. The idea is that you can sit on the couch, check and rebalance this portfolio once a year, and let it do its thing. Burns describes the implementation of the couch potato portfolio in an article from 1991. I would highly suggest checking it out, if for no other reason than to get a laugh. Here are some direct quotes from the article. Try this. Once a year, like when you add new money, you take the total value of your investment and divide by 2. That tells you how much you need in stocks and in bonds. So you move some money as necessary from stocks to bonds, or vice versa. With telephone exchange privileges at most mutual fund families, you can do this in less time than it takes to go to the refrigerator. Indeed, as a timing exercise, I suggest you put a medium-sized potato in your microwave. Your annual portfolio management will be done in less than the 10 minutes it takes to cook the potato. Call Vanguard, the mother of all indexers, at 1-800-662-7447 and ask to make the minimum investment in the Vanguard Index 500 fund, which mimics the Standard & Poor's 500 index, and the Vanguard Fixed Income Short-Term Government Bond Fund. Both have minimum investments of $3,000 and allow additional investments of only $100. That means you start with $6,000 and add as little as $100 at a time after that. Since the broad index funds used are somewhat arbitrary, for the sake of this video and the analysis herein, I'm choosing to use Vanguard's Total US Stock Market ETF VTI and the iShares US Treasury Bond ETF GOVT. Why the Total US Stock Market instead of the S&P 500? The S&P 500 is comprised of roughly 500 large cap stocks. Using a total stock market fund, we increase diversification since VTI has about 3,500 stocks and get exposure to some small and mid caps which have outperformed large caps historically. We can also ask, why would we use the Total US Stock Market VTI instead of the Total World Stock Market VT? If I were investing in the couch potato portfolio, I would probably use the Total World Stock Market Fund VT from Vanguard to increase diversification and get exposure to ex-US equities at their market weights. However, I realize that the vast majority of investors watching this video seem to prefer or embrace home country bias and only allocate 20 to 30% max to international stocks, using a combination of VTI and VXUS, Vanguard's Total ex-US Stock Market Fund. Since the couch potato portfolio requires the use of only two assets to maintain the fundamental simplicity, that's not an option here. I've created a global pie version using VT that I'll include in the description below. Why treasury bonds instead of corporate bonds? As I've said elsewhere, treasury bonds should be preferable to corporate bonds due to their superior volatility reduction and black swan protection in a long-term diversified portfolio, and have the added benefits of allowing you to avoid state and local taxes, credit risk, and liquidity liquidity risk that accompany corporate debt. Why treasury bonds instead of a total bond market fund? Total bond market funds contain some allocation to corporate bonds, usually about 25 to 30%. So without further ado, my interpretation of the couch potato portfolio is as follows: 50% total US stock market with VTI and 50% total US Treasury bond market with GOVT. Going back to 1972, here's the couch potato portfolio's performance versus the S&P 500 through July 2021. I have to admit, I expected the difference in return between these two portfolios to be much greater. Interestingly, the couch potato portfolio achieved a lower CAGR than the S&P 500 with roughly half the volatility, much smaller drawdowns, and much higher risk-adjusted return as measured by Sharpe. This is from the bonds doing their job of protecting the downside risk of stocks. Granted, most of this time period after 1982 was great for bonds. The future may look different. You should be able to implement the couch potato portfolio at any major broker. I think M1 Finance is great for US investors to implement it because it makes annual rebalancing seamless and easy with one click, which is consistent with Scott Burns' recommendation of simplicity and low effort. M1 also has zero transaction fees and incorporates dynamic rebalancing for new deposits. I wrote a comprehensive review of M1 that I'll provide a link to in the description. So once again, utilizing one ETF from Vanguard and one from iShares, we can construct the couch potato portfolio like this: VTI at 50% and GOVT at 50%. And again, I'll add a link to this pie for users using M1 Finance in the description below. If you're like me and you want to diversify globally and include international stocks on the stock side of the couch potato portfolio, we can simply replace Vanguard's total US stock market fund VTI with their total world stock market fund VT, like this: VT at 50% and GOVT again at 50%. I'll include a link for this pie as well in the description. What do you think of the couch potato portfolio? Let me know in the comments. Thanks for watching. Some of the links below are referral links at no additional cost to you. If you choose to make a purchase or sign up for a service, after clicking through those links, I may receive a small commission. This allows me to continue producing high quality content on this channel and pays for the occasional cup of coffee. I have first-hand experience with every product or service I recommend, and I recommend them because I genuinely believe they are useful.